The market mood is shifting. US assets, long viewed as a global safe haven, are under pressure with bond market jitters and soft inflation data adding to that uncertainty. As tariff risks rise, investors are left wondering, is the US now on the losing end of the trade war? Joining me today is David Scutt, APAC Market Analyst. Good to see you, my friend. Have US assets lost their safe haven shine? What's the story at the moment? And we'll run through that chart as well.
G'day, great to be back. And that's the question at the moment that I think everyone collectively in markets is thinking about, because for such a long period of time, the US dollar denominated assets has been the ultimate safe haven, including in treasuries. But just over the past week or so, we've seen a very noticeable disconnect. What you're looking at on your screen there is the difference between US and Japanese, German and Swiss 10-year bond yields from left to right. And then the very right-hand side is the US dollar index. Now, normally what we'd go and see is that when you see higher US yields, given it's the reserve currency status and a safe haven, it would go and benefit the US dollar. But over the past week, we've seen the exact opposite. The US dollar index has been absolutely smashed. And that's got people concerned that potentially mistrust in the US, because of what's going on with the political situation there, is now starting to filter through to where asset allocation is also going.
Okay, so bond market dysfunction persists. Why is that a red flag for risk assets? Take us through a little bit further.
Yeah, look, I'll try and get this as simple as possible. What we're seeing at the moment is that Treasury yields in the United States, the most ultimate safe haven, at least up until recently, are now starting to go and trade higher than other market instruments that are perceived to be riskier in nature. Now, what that means in a nutshell is that there's some serious dysfunction at the back end of the US Treasury curve. And what that means is that you've got what that is used to go and price off asset valuations elsewhere. If that can't go and be priced effectively and it can't go and be controlled, then there's some serious malfunctioning going on in parts of the financial system. When you talk about what that means to other asset classes, like equities and the like, that is definitely a massive negative and a bearish outcome at this point in time.
Yeah, okay. So the GDP now chart suggests the US may already be losing the trade war. Do you tend to agree with this sentiment?
Yeah, well, look, some of the data that's been coming out recently in the States, whilst a lot of it is soft data, survey-based data has been very weak. What we've seen is that you can see on your screen there. So this is what comes from the Atlanta Fed, and it's got a GDP now. And what it aims to do is collate a whole bunch of economic data together, and then it spits out an outcome as to where it sees growth in the United States sitting in the first quarter of the year. And right now, when you go and exclude some of the impact of the trade war and a front loading of a whole bunch of assets coming through, particularly gold imports, what it's saying is that we're on track still for a negative growth quarter. That suggests that uncertainty in the United States is now starting to go and play through and make concerns there about a potential recession.
Yeah, so March inflation came in soft. What's behind the weakness there?
Well, that's a really good question, because there was evidence potentially we might go and see some of the first initial impacts of the trade war, high tariffs in place. But instead, we got the first negative CPI figure since the start of the pandemic, May 2020. And then when you strip out some of the other details, one area that you should watch very closely is what's called core services, because that gives you a bit of a sense as to what's going on when it comes to organic inflation pressures. And they were very, very weak, less than 0.1% increase, which suggests, like some of that other data we're seeing, that momentum in the US economy is slowing down.
Okay, so rate cut expectations are still sluggish as well. How much of that is due to the inflationary impact of President Trump's tariffs?
Yeah, in a normal circumstance, if you get a very, very low inflationary print like we saw last night, and you see clear evidence of a slowdown in the economy, the Fed would normally be looking to go and move pretty aggressively on rate cuts. But right now, it's in a position where it can't be so confident that there's not going to be an inflationary tail to this, because, of course, higher tariffs means higher consumer prices eventually down the line. So we've got around about 84, 85 basis points worth of rate cuts priced in from the Federal Reserve this year. In normal circumstances, given the current situation we're dealing with right now, I would suggest it would be a lot more than that, probably up around 150 basis points or so. But we can't go and get excited about the prospect of a lot of rate cuts coming through, because, again, that indicates that there's something very, very wrong in the US economy.
Absolutely. So what are you watching in today's session? Any major market catalysts you wanted to highlight for us?
Look, at this point in time, it's probably going to be another very ugly session. ASX 200 SPI futures are currently off about 1.5%. Watch the Japanese market as well. We saw the Japanese yen strengthen a lot overnight, and that's going to go and hurt exporter earnings in Japan. So they could have a really, really big decline coming through again today. The circuit breaker that markets, investors, traders are looking for right now to try and alleviate some of this stress is either a trade deal from the United States being announced. There's lots of talk about a potential deal being close, but nothing's come through yet, so we're still waiting for that. Alternatively, of course, if we see some sign of compromise coming through from China when it comes to the latest increase in tariffs in the United States, 145% tariff rates now. We don't know how China's going to respond to. If it maybe goes and sits back and doesn't retaliate to this retaliation, that could also be a slight positive at the margin.
Oh, I'll take a slight positive where I can. David Scutt, thanks for joining us on the program, giving us such a great rundown. Look forward to speaking again down the track.
Always great to be here. Take care.